Hello, everybody, and welcome to the LikeATortoise channel. Happy Friday! And today I want to follow up on my previous my last video on YouTube, also about PayPal. And I want to say that I generally believe PayPal can 2x our money over the next 3 years, which means a 24% annualized return. So, without further ado, let's jump right into the video. If you haven't watched my previous video, then you can just go to the video section and click that button, and I just walk you through the main highlights of from the earnings report and the conference call. But today, I want to shine some light on a few things, because I've been reading many articles on PayPal, and I can see that analysts across the board remain skeptical. And to some extent, I understand that, because they are paying a lot of attention to PayPal branded checkout online, which is what drives their most profitability. The most profitability. These are branded experiences. At checkout, you can see the PayPal button. It makes sense, right? Because they don't have to share fees with third-party agents, and so PayPal not only can control the entire the end-to-end experience, and this of course makes it more profitable. And what analysts are pointing out to is that over the last several quarters, if you look at the presentation report, you will see that this has remained pretty flat at about 5%, and that's some cause for cautiousness, all right, and certainly some cause for concern, because analysts want to see that upticking. And I understand that once again, but there are a few things here that I also think are important to highlight. If you, this is the previous report that I shared with our community members in our school community. And what we saw in the previous management was that the PSP unbranded transactions, so the PSP segment, was initially in the former management, if you know, PayPal was more focused on high volume, low profitability. Okay. And so they wanted to grow at all costs without paying attention to profitability. But clearly that didn't work out as expected. And sure enough, what happened is that this segment did not end up contributing to profitability that much. In fact, what we saw was this segment going up while transaction margins were coming down. Okay, exactly because of that. What we are seeing right now is that the PSP unbranded transactions are growing at about 6%, if I'm not mistaken, if you look at the report. And this includes Braintree, of course, and now they are contributing more to profitability. And this is exactly because PayPal, as you probably know, has been firing many of their previous unprofitable customers. So they renegotiated contracts with them, and they say, listen guys, what do you think you should pay for the service? So they discussed new pricing, and those that could not afford or were not accretive were just let go. And I like that, but still, we are seeing the payment transactions still negative 5%, but over time, precisely because branded transactions should increase, I believe they will, and also because PSP and Braintree will start contributing more to profitability. I think it's just a matter of time before we start seeing payment transactions becoming positive. Okay, certainly over the next few quarters. That's what I'm expecting, and I think this will be very, very bullish, because payment transactions, as you know, it's one of the most important KPIs for PayPal, and I share here. This means is a proxy, right? Payment transactions per active account, a proxy for user engagement. If there is user engagement, this means that they like the product, they are sticking around, and that leads to more transactions on the platform as well. Okay. In fact, payment transactions is, as you can see, total number of successfully completed payments processed processed through PayPal. So let's discuss why the analysts make such a big deal of the branded checkout experience. And I share that here as well. And you can see that branded checkout, guys, is the classic pay with PayPal or pay with Venmo button. This is the core of PayPal's economic engine. This is where PayPal has number one highest margin transactions. As I told you, this when users use the branded button, this means they essentially place PayPal has the entire end-to-end control. So they control the entire back end and front end flow. And so there are no external processors taking a cut because with Braintree, that does not happen. So PayPal has to share fees with the third parties, right? With these external processors, because they only control the backend. And number two, trust plus network effects. Branded checkout benefits from global consumer trust, merchant acceptance built over 20 years, strong fraud prevention track records. What PayPal has achieved over the last 20 years takes time. And not, I mean, and we can talk. For example, myself, I'm not trusting I'm not trusting my bank account details or that sensitive information with any payment processor, right? I mean, it needs to be a reputable company, of course, a company that maybe other people that you know already use it, are happy with the service. And PayPal has built that reputation over years, and it's very difficult for competitors to actually take that away from them. Okay, it's not easy replicable. And sure enough, they have evolved, and now they have strong fraud prevention solutions and in a very good track record in that regard. Direct relationship and data. This is probably one of the most important aspects of the branded checkout experience. They know the buyer, right? They control the checkout experience. They see the purchase behavior. And then, because they are controlling the entire experience, they can upsell. They can promote Venmo, buy now, pay later, and other things. So it stopped being just a processing payment service provider, but now they are owning the whole relationship. And sure enough, we are seeing ads, we are seeing cryptocurrency solutions, all these products that are going to be accretive longer term. So it's like I see PayPal right now as though they are planting the seeds for what's going to be inevitable. And then, of course, pricing power. Everybody knows PayPal. If customers want to use PayPal, what do you think merchants will have to do? They have to introduce PayPal, right? In order to see a higher checkout conversion. So because consumers will trust the button. And so merchants are willing to pay higher fees for branded transactions. This all makes sense. If you compare that with branded checkout, Braintree, right, which is a payment that PayPal acquired a few years ago, and he offers a payment, it's a payment solution provider, high volume, lower margin, highly competitive. Historically, PSP drove scale, not profit. Now, under Alex Chris, we are seeing a turnaround, and that has become quite apparent in the latest report. They continue to project Braintree growth over the next few quarters, which I like that. They have been repricing contracts, removed fired unprofitable customers, improved PSP economics. And this is why we now see PSP contributing to transaction margin dollars instead of diluting them. Okay, so this is the main thing that I wanted to share with you, and it's part of the reason why investors continue to focus on branded checkout. But as branded experiences, with all the partnerships, with all the products that PayPal has been launching, I think it's just a matter of time before we start seeing, number one, payment transactions going back up, and number two, PSP contributing even more to those transaction margins, and I think that that's going to bode very well for the company. Okay. All right. So now that I've just broke this down, I want to talk a bit more about why I think PayPal can 2 times our money over the next 3 years. Okay. And for that, I'm going to do a very simple, well, I will do one simple exercise and another one that is a bit more complex, but something that I will break down very, very meticulously. So let's go back to our screen here on stock analysis. And this is very simple. Okay. So for you to double your money, this means um, PayPal would have to trade at so 67.93. If you multiply that by 2, this means 67.93. We want to double our money, so this means PayPal would have to achieve a $136 per share mark. Okay. And let's say at the end of that period, PayPal trades at the PE of 20. And for those of you who don't know, the 5-year average, the historical 5-year average for PayPal hovers around, as you can see, I was doing that research, about 32.91. So let's call it 33. So for PayPal to actually trade at a PE of about 20 is not that big a deal, right? I do expect that to happen, and I think I'm already being conservative because it's such a profitable company with such growth potential that I think there will be a repricing down the line, but I don't know how long it will take. But I'm assuming PE can go up to 20 in the next 3 years. Let's do that exercise. And sure enough, if you divide 135.86 by a PE of 20, you can see that you get earnings per share of about 6.8. 6.8. Okay, so this will be like the future earnings per share, say in 3 years, if provided the assumptions that I introduced here are correct. And so what is, considering earnings per share today sit at about 4.98, to go to 6.8, what exactly is the compounded annual growth rate if I want to achieve this in 3 years? And if you go to our calculator, you can see I've already input these numbers. 4.98 ending value 6.8 in 3 years. That's about a 10.94% annual growth rate. So is this a big shot? Is this being too optimistic? I generally don't think that. So I certainly don't think that is the. I don't think this is too optimistic, too bullish. In fact, you can see, for example, that over the last 5 years, if I go here to my intrinsic, let me go here to my document because this is where I delve deeper into the companies. If I go here, where is PayPal? Right here. This is it. So if I go here to my earnings per share growth rate, you can see that over the last 5 years, PayPal has grown earnings per share at 22%, and over the last 10 years at about 17%. And sure enough, more recently, if I go here to financials in the trailing 12 months, you can see that earnings per share growth. Look at this. Okay, so it was sluggish, but now look at that, 3.91% back in 2024, and then you can see that this has been upticking 11, 12, and now 18.59. And as you know, they revised guidance upwards, which is also very, very bullish. So I don't think 10% is that big a deal. I think it's very conservative, and it has already a margin of safety built into it. So if that happens, guys, what this means is that for us to double our money in the next 3 years, PayPal would have to be able to execute on that. So they would have to achieve that minimum acceptable rate of return for us to double our money. But even more interesting even more interesting is an exercise that I did that I want to share with you guys as well. And this is Manish Pabrai's Cannibal's Return Formula Explained. And why this is so important is because PayPal is by any doubt a cannibal company. This, guys, is a company. If I show you here again, I'm showing you the trailing 12 months. So let's change. No, let's keep it like this. Look what happened to the shares outstanding if we go back to 2021. This is remarkable. So since 2021, they have reduced the share count by almost 20%, which makes this company a cannibal stock. They are eating themselves by aggressively buying back their own shares. And so I decided to use the Manish Pabrai Cannibal's return formula to see what kind of returns we can expect going forward if provided certain assumptions are met. Okay, so this PayPal currently has approximately 960 million shares outstanding. So you can see that is exactly the case. If I go to financials during 12 months, you can see these are the shares outstanding diluted, 987. Okay, let's go back. Well, actually, it's a little less. So yeah, but anyway, I mean, this is just consider it ballpark. 960 million shares outstanding. Let's consider a realistic scenario based on the company's ongoing share repurchase capacity. The company deploys 4.5 billion per year over the next 2 years. Why? How did I come up with this number? The reason is that in 2024, PayPal used 6 billion to repurchase shares. That was about 6 billion. And the board of directors, and you can see this if you look at the annual report, they approved, so they still have about 15 billion left to buy back shares. And out of those 50 billion, they have already used a portion. Okay. And so if I'm just considering 4.5 billion plus 5.5 billion times 2, which is about 9 billion. They have already used the other ones for the rest of 2025, which there will be another quarter. So I'm just considering the remaining portion, okay? And if you do that, you can see that, so 4.5 billion per year over the next 2 years to repurchase shares. Let's consider the price stays the same at about 70. This would reduce the share count by approximately 128 million shares over that same period, right? So then over the subsequent 5 years, let's assume PayPal continues to repurchase about 5 billion worth of shares per year at an average price of $90 per share. And this means that they would retire an additional 270 million shares. So in total, this would result in about 406 million shares repurchased over 7 years, which equates to a 42% reduction in the share count. You just need to do 406 million divided by 960 million shares, and that gives you, well, it's a 42% reduction in the share count. Substantial, okay? And if you don't know that, what that can do to your returns is just staggering. For example, if I go here, I still have what Manish Pabrai shared not that long ago about buybacks and how they can create so much value going forward. Come on, more trades. Note, evidence in buyback. So if I go here we go. Look at this. Okay, so if they look at that, shares bought back, magic really starts to happen after 50%. That means because if they buy back 50% of your shares, even if you assume earnings stay the same, what that will do is it will double your money. Okay, and the more buybacks the company executes, the more value they will create for you as a shareholder. And PayPal is certainly on that. Is certainly on. Is certainly doing that. Okay, wanting to achieve that. And okay, so this implies shares outstanding decline from 960 million to roughly 554 million, which means 58% of the current share count remains. Okay, what's Monish Pabrai Cannibal's framework? You just have to do your assumption in terms of earnings growth, and I'm assuming that earnings can grow at about 40% per year. Okay, well, actually, earnings growth. No, sorry. I'm assuming, yeah, here we go. I assuming earnings growth at about 13% per year. By the way, analysts are being even more optimistic. If I go here to statistics on stock analysis, you can see that analysts are assuming 16% compounded over the next 5 years. Okay, so I'm being more cautious, also playing it safe. Let's go back. And then you have to times that 100 divided by shares percentage left times multiple expansion or contraction, and I'm assuming the valuation multiple will expand from 40 to 20, which implies over a 10-year it implies over that 7-year period 1.43 times. Okay, so the how did I come up with this 2.33 times over 7 years? Because this is the future value, right? So you just have to do 1 plus 0.13, and then you just do it at 7, and I don't recall how to call this in English. Apologies, but you get what I mean. And if you do all the math here, then you can see that what you will do in the end is you just need to plug in the numbers. So we have 2.35 in terms of earnings growth. Then we have 1.72 in terms of share reduction benefit, because this is how he calculates it. So you just do 100 divided by the remaining, so the remaining shares, which are 58%. And then this equates to 1.72 times, which is what you see here. And then I expect the multiple to expand from 40 to 20 times, which equates to 1.43, and that leads to a 5.8 times return over 7 years. And if you do the math, you can see that if this happens, a 5.8 times return over 7 years, this means you are effectively compounding your money at 29% annualized. Okay, now, granted, there are a lot of assumptions built into this formula, things that can or cannot materialize, which is why I used margin of safeties across the board. So I use 13% earnings growth when analysts are more bullish. I assumed 5 billion worth of shares per year. PayPal has actually been using $6 billion worth of shares. In fact, 6 billion is using 6 billion of its free cash flow to buy back shares. So I decreased that a bit, and I still got this annualized return. So guys, I mean, long story short, and I do think you managed to take away important information from this. But I'm very constructive on this company. I think Alex Kreis will planting the seeds for great things to come. All right. And I see all the turnaround ingredients coming together. And for example, if I share the yearly, you can see that, for example, total revenue never stopped going up. This revenue, the reason revenue has actually declined a bit more, in fact, has been a bit sluggish, is exactly because, as I mentioned before, PayPal took they took the initiative to get rid of many of their low margin customers. They were not being accretive, and so this impacted the top line. But I think it's just a short to medium term thing. So revenue should accelerate. And then if you can see, look, I mean, net income and earnings, look at since 2023, they have been going up. In fact, if I zoom out, you can see that these are the highest levels of net income going back to 2016. This is by no means a dying company. It's very profitable. And if I look at their margins, so they are guiding for between 6 to 7 billion of free cash flow by year end. And if that happens, guys, that will be the year where they generate the highest level of the free cash flow. This is an amazing, a very profitable. It's just a cash machine. It gives them a lot of optionality here. They can reinvest into the business. They can buy back a lot of shares while they are cheap. And yeah, and then if I go to metrics and if I look at margins, you can see that margins were going down, which is not something that I like to see. But under Alex Chris, things are turning the corner. Okay, this is gross margin. Net margin took a bit of a dip this quarter. Look at that. Okay, I want to see this rebounding. So let's see if that happens, because things were actually being great under Alex Chris. Look at this. He improved margin substantially. So I like to see that. And then if I go free cash flow margin, look at this, right? And then look at the operating cash flow margin. Very bullish. All of that since Alex Chris took over. I mean, and considering all the partnerships that PayPal has been entering and all the products they are releasing, I think there's a lot of untapped potential. And certainly they are doing what they should be doing to steer the company back to its next destination. Okay. So, I mean, look, I hope this was educational, instructive, and I do share a lot more data with our community. So if you guys can, you can join our school community. It's entirely free, and yeah, I mean, and you will see, of course, that I do share a lot of insights into my personal portfolio, and my goal is not only to grow the channel, but actually to see that you guys are thriving by, for example, investing in some of the companies that I'm investing in, after doing your own due diligence, of course, always important to mention. But I want you guys to grow as well, because if you grow, I grow, and that's why I will see you always as partners. And that's why this is so important. So look, if you found the video insightful, smash the like button, share it with your family, friends, people who love the market but are not being profitable. And I think yeah, I mean, I want to continue I want to continue putting out more content like this. Okay, so have a great rest of your day, and I'll see you in the next video, everyone.